Hello, everybody. How are you? This is Stephen Padernacht with the Padernacht Real Estate team at Keller Williams. And are you guys ready for another deep dive into the mortgage world? I surely hope so. And if you're tuned in, I would assume so. This is episode 9 of Mortgage Matters with our go-to expert, Christian Babcock from the Loan Depot. This week, we're tackling a question that's been on everybody's mind. I actually got a question from somebody today about this. Why the heck are interest rates so different from person to person? Well, if you want to know the answer to that, then stick around because we're going to get right to it. And just remember, it's not just about numbers, it's about you. So tune in every week as we debunk and run through the most recent mortgage news. So without further ado, let's get my buddy Christian on here. How you doing, my friend?
I'm okay. How are you?
I'm doing good, doing good. Still waiting for that thumbnail image, my friend.
Some technical difficulties in the back office there.
Still, yeah. So, how was your trip?
Good. Yeah, came back alive. It was definitely a good trip. Thanks for asking.
My pleasure. You came back when? You got here on Tuesday, you said, or Wednesday?
Yeah, I came back Tuesday. Yeah.
In and out, nobody gets hurt.
That's it. Had a good time.
It's tough when you have wife and kids at home for you to spend extended time away. I imagine.
Yeah, it's not right. It's definitely not right. So I missed you out
it's
here.
Work, babe. It's work, babe. Trust me, it's work. I'm going to Las Vegas for work. Trust me.
That is 100% accurate.
Did anybody have a drop top out there this time?
I didn't see it. I think one guy had a Jeep.
Okay.
But nobody really rented a car or ventured too far from the strip.
Yeah, that's my calling card for the trip, right?
Yeah. No, that was it. That was a good time in Dallas. I remember that.
Yeah. So how's business going?
It's good. It's good. Very busy, actually. Especially around here, when we have a mild winter, things usually carry through. In tough winters, that's when you see more of the seasonality. Less activity. People are, not wanting to really venture out too far when you got 2 feet of snow around and bad weather. So, when it's a mild winter, we usually stay pretty consistent. So I actually just had a Facebook memory come up. I was just telling my wife from 9 years ago, and it was a video of a woodpecker in my in my yard, but it was like 2 feet of snow, and it was snowing. It was actually snowing when the video was in. It was already like 2 feet of snow here from 9 years ago, which was only 2 years after we bought our house. So it's very different winter.
Yeah, I remember, and this is so random, but I remember going to opening day. I mean, I must have been a kid. I was like, it was like a school trip or like Boy Scouts or something like that. And opening day, Yankee Stadium, and there were snow flurries.
Yeah,
so you're talking like, I mean, it's got to be, I'm 40, got to be like 30 years ago, but it was snowing in April. So it's just so crazy how we get such.
We had that blizzard. We had a blizzard back in, I think it was. I'm dating myself now. I think it was like 2009, but a foot and a half of snow back then. In April, in middle of April. So that's what I like about New York. It's full of surprises. It's never over till it's over. Even after sometimes the flowers grow, you might still get a flurry. So.
Yep. I vividly, I remember I've had St. Patrick's Day where I'm out there, downtown hanging out, and it's short sleeve weather, or you're out there in a scully and a coat.
Or a coat with shorts on.
It's interesting the way like our mind works, right? Like we're just talking about like when we were kids or teenagers or whatever, and it plays now into our business so much. Like for us, like, and now, like, listen, so, that I'm an investor in properties as well. I want mild winters all the time, especially when I'm paying for heat and I'm paying for, somebody to shovel the driveway or get a plow truck out there. Like I want mild winters. And as a landlord and as an agent for the buyers, because it's just easier to get around. And buyers, for some reason, once they get bunkered down and you got a blizzard, it's hard to do showings. Like it's
Nobody. I mean, unless you really need to move or want to move, you're not really venturing out and in a snowstorm to go look at houses.
No,
so,
surely not.
Right.
Surely not. And
so we read, again, it's picked up quite a bit. We got a lot of contracts coming together. I mean, I've had a lot of people pre-approved for quite a while that we're having a hard time now. They're getting contracts. So just kind of have a flurry of people that I've been working with that are getting contracts signed now. So.
You know how I could tell you're busy?
How?
I can tell you're busy because it takes you if you don't get right back to me, it takes maybe like an hour to 90 minutes. That's how I know. And that's a compliment. Like,
thanks. Thank you.
Like seriously, like, because you're so good at like, especially when it comes to like emails with the buyers or like Saturday night. Like, I don't know if you just have your computer with you at all times. Christian, we need an updated pre-approval. We want to put an offer in, and like within 5 minutes, you're getting that pre-approval. It's a real testament to how hard you work and the level of service that goes in. And I try to do that also with my business, right? Like it's hard, right? And now it's easier now because Jen is in the business. And she understands, like,
yeah.
So like now I'll be sitting there like, we're watching whatever, we're just having whatever QT and we're watching something on TV, and then she'll get a call and then I have to like pause it to wait for her to finish her call. And I'm like, wait a second, this is not.
No, listen, that's the life. It's if you don't pick up, someone else is gonna. That's the way I always run my business. It's people will not wait. They, especially in a market like this when things move so fast. That waiting for that updated pre-approval through a weekend means you can maybe not get that house. So I'm always conscious of the fact that there's someone on the other end that's like biting their nails, like wanting to get an offer in, and I got to be that person to support them.
It's very interesting to me to see. Especially, and I'm not here to bash professions, but like I think that just people who are not so active and they've been in the business for so long, they're so used to the pace of like, okay, I send a memo today. All right, cool. I'll send out a contract in 2-3 days, or we'll get the appraisal booked for sometime in 2 weeks. Like they're not understanding the market of the moment. Like you have to. Speed is everything at this point, and they don't really understand the pressures that we're facing as agents when we're presenting the offer. Like, no, listen, I got Babcock, he's gonna move fast. I've got an attorney, they're gonna move fast. I've got this, they're gonna move fast. And then all of a sudden, it's like you're stuck in the mud, and it's like, wait, we approved your offer because of this. It's just the market of the moment is so important.
Well, that's exactly right. You got to adapt. You got to shift, because what you're describing, when you're in a buyer's market, you could take your time, because if you were the only offer in the last 6 months and the seller took your offer, things move a little slowly and you could take your time. But when you're in a seller's market and you're one of 10 offers and it really hinges on, you need that updated pre-approval behind your offer. By the time, if it's 1 day, 2 days, even a few hours, they can go with the other person who maybe it was at the same price, same down payment, but got their paperwork in faster. So you have to adapt to the market of the moment.
Yeah, I mean, we were talking earlier this morning about how like they said that they were going to deliver a contract, and they're like, okay, well, what time? When are they going to be there? The office goes, have they done this? And I'm just like, listen, there's only, and I have to like push back at certain times. Like there's only so much that I could physically do. I can't go there and physically move people. But for you and I think that that's why we get along so well, is because both of us understand that importance and we try. I mean, listen, we're only missing one party between you and I to be able to get a deal done. So like, it's just a matter of, pushing some people.
Yeah. No, exactly right.
All right. So, talk to me about some mortgage news. Any big reports this week? What are rates doing? What do we got that we can kind of talk about a little bit?
Still some volatility going on rate wise. They were up in February. Came up about 0.5% from where they were from the beginning of February to the end of February. So 30-year fixed rates still hanging around in the upper sixes as opposed to lower sixes. But still, I wouldn't call it stable. I would definitely call it kind of flat, Right now there's talk about the Feds maybe pushing back their rate cuts later into the year because the inflation numbers didn't come out as favorable as they would have liked, which kind of is the mantra we've been hearing for the last 2 years. But again, at least inflation is not running out of control and rates are going up every day. So we're seeing bumps in the road here and there. I'm recommending to most of my people to not lock in right away, especially, I have some people that are entering contracts right now that are making deals with the sellers. They're not closing till June, July. I have people that are, new construction homes that aren't ready yet. So, there's really no rush at this point to lock in a rate if you're that far out on a closing. But in the shorter term, it gets a little more hectic when we have people that are getting ready to close and haven't locked in yet. Still, okay. I'm still not sleeping well, but, but someday I will.
All right, so rates are pretty much flat right now. I was listening to the vision speech that Gary gives every year, and the first year I went to family reunion, I was like, "Oh, this is a snooze fest." The second year was, I believe it was digital. Third year, I was like, wait a second. I was like, this is actually what's going on in my market as well. Fourth year, same thing. This year, I was like glued to listening to how he's describing the markets and the volatility and understanding the rates. And he always gives the example of he started the business in like the late 70s, early 80s, where rates were like 16, 17, 18%.
Right.
And if you look over the course of the entire, since they've been tracking the rates, like we're not really that much higher. Like 5.2% is like the average. So we're a little bit higher, but people were so used to the 2s and the 3s during COVID that they're like, oh, forget about it. I'm not buying anything right now.
Right. But even before COVID, we were in the 3s for a long time. High 3s, breached 4 every once in a while, but then for the most part, mid to high 3s was there for a while, about 2 years before COVID. So people were used to even hearing that. And then 2s was a nice drop, but which I don't think anybody expects to ever really happen again. But we were, for the last, 20 years that I've been in this business, 22 years this year, actually, all I've seen, and mostly everybody in my profession has seen, is rates going down in those 20 years. So, there were some bumps up and down, but if you look at a trend line, so it's been a steady decrease. There's been refinance booms in between. So it's kept a lot of people in business, kept a lot of companies alive, because there was always a refinance kind of boom in there, in that mix every few years.
Yeah, because when you're starting at 17, everything is going down, and it's the bumps that you're talking about. And then we went all the way down, during COVID, and now
and it's like a V correction.
I'm just telling people we're just in a bump. Like just just relax and understand the end game. And you and I have talked about this so many times.
Right.
What is your end strategy? Are you going to be in the home for 5 to 10 years? Are you understand that, and understand that you're probably not going to get hurt. I posted a clip this morning of you and I talking last week and talking about big city, and New York City, and how we're kind of not immune to the fluctuations because of all of the activity here, but it's so relevant for people to understand, especially for you and I that are doing business here in New York. Just understand your end plan. If you want to be out in 5 to 10 years, you're going to be okay.
Right. No, exactly right. And the unique thing about this cycle is that it was such a dramatic change in rates in such a short amount of time. We were in the 2s for about a year and a half to 2 years, and then they went as high as 8 within that's almost the same year. That's I don't think anybody's really seen that kind of spike straight up for such a consistent period. So it was a rough year. The second half of 2022. Because it was not so much that it was that where they are now. Yeah, right now everybody's used to hearing 6s, so now it's becoming normal. But when it happened, nobody has seen that kind of sharp increase in such a short amount of time. As long as I'm doing this, a 0.5% increase in a short amount of time was like the sky was completely falling.
Yeah,
to go from 2 to 8, that's 6% increase. The sky was falling.
Yeah. And I don't want to get too deep into why those rates shot up like that, because that's not the purpose of today's conversation. But it just, for me, it just underlines the fact that you have to just be informed.
Mhm.
and get your news from reliable people, understand what's going on, understand and not just like scrolling through TikTok or scrolling through IG and every single person like
Mhm.
just doesn't understand what's going on, like you have to really be informed.
Right. Right. No, exactly right. Exactly right.
Okay, so what I'm gonna do is we were talking about interest rates and
Mhm.
how buyer A is different from buyer B. Now, buyer A has let's just run through a scenario. Buyer A, 740 credit score,
Mhm.
makes 70K per year.
Right.
Buyer B, 740 credit score, makes $195,000 a year. Are they getting the same rate, or like how do the interest rates get determined from buyer to buyer?
Right. So what you're referring to are called LLPAs, loan level price adjustments. Those adjustments are on conventional loans mainly. They exist on FHA loans, but not as dramatically in terms of how many boxes there are. So what an LLPA is, rates are based on levels of layers of risk. Historically, the riskier the loan, the higher the rate. And I've actually had buyers say back to me, which makes, when you think about it, common sense. Like, listen, if I'm risky, you're increasing my rate, making me riskier. To
Yeah,
let,
yeah,
so
exactly.
like, when you think about it from a common sense level, but that's not, what the agencies are looking at. It's the agencies are looking at, this, it's riskier because we're, if this particular borrower doesn't perform and that loan fails, and that's backed, by a mortgage-backed security within that certain pool, those are riskier assets than to an investor than other ones. So that's kind of the back end, brief synopsis there. So these LLPAs have already always existed, and what they are is, it's how I would price your specific interest rate. So if Steve is buying a single family house with 20% down or 25% down, and you have a 760 credit score, um, historically that makeup, single family is one,
Yeah.
credit score is another, down payment is a third.
Okay.
That would basically get you the best rate out there. And that's actually what lenders advertise. When people go on lender websites, if you read the fine print, it's always based on a specific down payment, specific credit score, and a specific property type. And it'll say it if you can find it in the fine print. So when so I get those, because I get those calls all the time too. Oh, you told me my rate was going to be around here. I went on, X bank's website and their rate says this, and then I always have to direct them, like, read the bottom. It's based on a 760 credit score, single family home, 25% down. That's not you. You are
Yeah.
buying a 2-family home with 5% down with a 660 credit score. So the reason that rate is different is because when you look at these LLPAs, is literally a grid that has loan amounts, LTVs, which is the percentage that you're borrowing versus the price, credit score, and there's all these adjustments in all these columns that get added into the margins into a rate sheet. So when you look at a rate sheet, my rate sheet goes from 2 3/4 to 8 3/4. So
Okay.
your rate is going to fall somewhere in between there. It's not going to be 2 3/4. It's not going to be 8 3/4. It's going to be somewhere in between, based on how these LLPAs are baked into that price sheet. So
So
let's say,
the
for example,
LLPAs are always. I'm sorry. So the LLPAs are always a factor. Like it's always been a
right,
factor.
always been a factor. Oh, so
Buzz last year. Like why? What happened last year?
so what happened last year is that the current administration wanted to make it more equitable and fairer for first-time home buyers mostly, but also people that might not have perfect credit or big down payments, to get those people not better interest rates than the first example, but better than what they would have gotten a year prior. So, because somebody prior with a 640 credit score with 5% down, buying, a single family house, that person's rate would be exponentially higher than the other example. 25% down, 760 credit score. So
Yeah.
they're not trying to necessarily level the playing field exactly. What they were trying to do is essentially pick, like, the people that were a little more credit challenged to not get hit as hard on the rate. And by doing the way they did that is they kind of are subsidizing those with the people with the higher credit. So where some adjustments didn't exist in different tiers now do exist in those credit tiers for the people with the better credit. So they made them a little worse for the perfect buyer and a little better for the non-perfect buyer to try to find some level of fairness in between. And then what they also did, which was good, is for first-time home buyers within with a lower moderate income area. So a combination of being a first-time home buyer with income below the 120 or 100% of the average income in the county they're buying in, those people don't have any LLPAs. So it's very possible that I have somebody with a 660 credit score with 5% down, but because they're a first-time home buyer and their income is lower, they have no LLPAs, so they would get the absolute best rate that they could get.
Wow.
But again, it's a combination of first-time home buyer and income.
Gotcha. So it really is affecting first-time home buyers for the most part. As far as it's benefiting them. It's benefiting them.
Most. Correct. Benefiting
them
most.
But you know how it goes, right? Like the headline, the sensational headline is
right.
Bad credit gets better rates than good credit.
Right. And they're not better. They could be better if they're a first-time home buyer. But we're not talking 1% better. We're talking maybe an eighth or a 1/4% better. So it's not, but the bigger thing that they did, which we haven't been talking about for investors and people buying second homes, they added in for second homes, not so much investment properties. Investment properties always had higher LLPAs just for the layer of risk of it being an investment property. So investment property rates haven't changed all that much. Second home rates got nailed because historically, your second home, which is essentially your vacation home, was treated as a second primary residence. So there was really no difference in rate between a primary residence and a second home. So what they were looking at, though, is places like Florida and places like, where, vacation type areas, people were investing and buying second homes in those areas, and they were pushing first-time home buyers kind of out of those markets. The people that actually lived there that wanted to buy in the neighborhoods that they were living in were getting pushed out by all this money coming in from New York and everywhere else in Florida. So they said, we want to try to stop or make it prohibitively more expensive for someone to finance a second home than a primary residence. So they added in huge LLPAs on second homes. It hasn't worked. It just kind of pissed a lot of people off because if people are trying to buy it, they're just gonna. And there's other banks that don't have that we broker to also that don't have the same hits. We're only talking about conventional 30-year fixed Fannie Mae backed mortgages. On Freddie Mac. We have alternatives for second homes. With other banks that don't have the same hits. So it just kind of forced people that are looking to buy second homes at either looking at some alternative products or just paying points and higher interest rates, and maybe they'll refinance in the future. But if they're determined to buy a second home, I don't think it's going to really push them out. It did some. I had some customers that when we went over what the differences were for investment properties, they were like, yeah, I'm just going to wait it out. So it did probably dissuade some people from buying, but not all.
And who determines these LLPAs? Or is it bank to bank, or is it something that comes down from like the Fed, or how does it get determined?
From the Fed, it comes in. It's baked into, as we were saying, 30-year fixed conventional loans. Fannie Mae, Freddie Mac, they're the ones with the LLPAs. So, and that's where 90+% of the loans end up nationally. So, but that's where it's coming from. Gotcha. So it's really, the current administration. Look, the government, whether you're Democrat or Republican, doesn't matter. They're always involved in trying to manipulate markets in a certain way to make it fair, or for different segments and demographics. It's never going to stop, or it's not going to end depending on who's in office. It's just it is what it is. And when in this business, again, being in it 20+ years, we've seen in different administrations come and go. We've seen different cycles. We've seen recessions. We've seen booms, and we adapt based on what the market of the moment is what you and I have always been talking about.
Yeah, of course. So secondary homes got hit the hardest. When you first said it in my mind, so again, like sensational headlines, right? That reads to me, punish the rich, right? Punish the wealthier people who can afford the homes. But when you uncover it and you explain it the way you did, where it's like, well, no, it's actually that we want to allow people who live there to be able to invest there and they don't get priced out of communities. It doesn't sound so crazy because they're not saying you can't buy there. They're just saying, listen, if you want to buy in that area, like whatever, South Beach or Cali or whatever it may be, it's going to cost you a little bit more money to be able to borrow money to be able to do it. And as always, cash is king. So if you're uber wealthy, you're buying that condo all cash and you don't got to worry about mortgage rates.
Right. Exactly. So, and that, but again, it's really just, they are trying to, manipulate the market to a certain extent to help first time. It's really in an effort to help first time home buyers that are even now still getting pushed out of the market just for low down payments and everything else. So they're making it a little more affordable there, a little less affordable, in one segment, and it just is what it is.
Interesting. All right. So, I just tried to, so what I try to do when we come up with topics is I try to give you real topics that people are sending me, or you come up with a topic that somebody has asked you. So like this was a big headline last year. And then, for whatever, a month, maybe 2 months. And then all of a sudden it just died out.
Right.
As everything else does, and people just kind of, it becomes the norm, and just like the sixes became the norm. Like 2 to 6 is a big jump. Like sixes are like the norms right now. So it's just
that post that you sent me. I won't name any names. I disagree with that strategy. So the post that you had sent me was a guy saying because of the differences in rates, it makes more sense for somebody to put less money down to get the better interest rate. So instead of putting 20% down, put down 5 to get a better interest rate. And then after you close, take that extra money and prepay your principal and lower your payments, called a recasting. That is a good strategy on its face, but what the part that they left out is that if you put 5% down, you're going to have PMI. And PMI doesn't go away if you prepay and recast for a minimum usually of 2 years.
Oh, so they're keeping that $200 or $300. That's what it is, right? PMI is about $200-300 a month.
As little as $50, depending on the loan size. It could be as much as $300 a month, depending on the loan size. So it really depends on the loan size. So yeah, you might be getting a slightly better interest rate. You're also taking a bigger loan to begin with, but the strategy that he was looking at is, all right, you prepay your mortgage, recast your payment. Yes, that would absolutely work because you'd be lowering your loan balance at the better interest rate. But then what about the PMI? You left that part out. The PMI just doesn't go away when you prepay it that fast. They have minimums that the PMI stays on there. So, that's just the one thing that I sniffed out as another mortgage person.
We should get you. We should get one of these guys. There's these guys on social media. What they do is they take a video like that, they put it on like in like the green screen, and then the one guy is like, this guy's full of crap because of X, Y, and Z.
I wouldn't do that. I wouldn't. I mean, I do that privately. I don't know if I would put that on social media. I know what people are trying to do, and unfortunately, as I've said before, people can become experts on social media, and just by saying they do this now, and people are finding out, that there's a lot of empty suits out there that are just trying to get their phone to ring, which is great. It's a strategy. But if you're putting stuff out there, be accurate. That's all.
Yeah, I agree. I agree. All right. So I would like to just close this out with some debunking.
Okay. I got a couple debunking. We got a minute. You didn't prepare me. I got you. I don't know what's coming.
Yeah. No, listen, it's all right. I'm going to give you one. All right. Adjustable rate mortgages are bad. Fact or fiction?
Fiction. So, but they are just designed for the right buyer who understands them, and you're working with the right lender who knows how to explain how they work.
I can't qualify for a mortgage if I don't have W-2s.
Fiction. You can be self-employed, you could be 1099, you can own a corporation, you can have LLCs, so you do not need to be only a cookie cutter W-2 employed borrower. It's hard, sometimes more challenging to get self-employed borrowers approved, but even now there's alternative non-QM loans that we can work with those buyers, even if they don't qualify the traditional way with tax returns.
Non-QM. We talked about that a couple of weeks ago.
Yep.
All right. I have equity in my home. Can I use that to buy another property?
Yes. You can borrow from the equity either on a home equity line of credit, a cash out refinance. I'm actually doing one right now. I have a guy that owns his house free and clear. We're doing a $400,000+ cash out refinance on his primary because the rate's better, and he's going to use that cash to buy an investment property, all cash.
His rate is better in this market than it was.
Well, the
what he
rate is
had?
better. Well, no, he doesn't have a mortgage now. He owns his house free and clear.
Oh,
So
gotcha.
but the rate is better because we're putting the loan on his primary residence as opposed to putting it on the investment property.
Gotcha. Okay. All right.
Because of those LLPAs.
It's funny how everything just ties in, right?
That wasn't even planned.
Boom. All right, Christian, thank you so much. Everybody, thank you for joining, and we'll be back next week with episode 10. Take care, everybody.
Thanks, Steve.